It's almost the end of the year, and through the year 2018, we've been, seeing a lot of movement on different sectors, and now it's time to recap the year gone by. So let's take a look at what has impacted the market and the economy. Here's Nigel with a look back at the cement industry. Nigel, over to you.
Well, to summarize this year so far, the volumes have been good, capacity utilization levels have been good. What really spoiled the party was, in fact, the input costs did spike up. So if you look at the capacity utilization levels, well, you'll see that it's been moving higher. In the last couple of years, it did see a bit of a dip, but now it's back at around that 67% odd. So no worries in terms of capacity utilization. The problem came in when petcoke prices moved from around that $90 to $100 per ton all the way to around $120 per ton. But good to see that as well has cooled off from the recent peak. Now, if you're looking at, what exactly happened to the profitability, then that dipped by around 60 to around 70 rupees on a per ton basis because of the higher input cost, and the selling price didn't go up as much. Well, there were a couple of big deals as well that took place in the past year. The big one, UltraTech and Century Textiles, we awaited for many, many years. Now it's come through. UltraTech Cement will take over nearly around that 13 million tons odd. There's a merger ratio as well that was firmly in favor of UltraTech Cement. Century Textile shareholders weren't very, very happy. But it was a good deal, remember, for UltraTech Cement, because it trades on an EV per ton of around $200 or thereabouts. They're getting this entire entity at an enterprise value of around 8,600 crores. That's including the debt number of around 3,000 crores. And they're getting an asset at the cost of a greenfield project. So that was a positive. There's a big difference in terms of EBITDA per ton as well. Nearly around a 400 rupee difference between UltraTech Cement and the Century Textiles deal. So to sum it up, it was good news because the valuations were good. It'll be EPS accretive from the day one itself. And when a stronger player is taking over a weaker player, there's a likelihood that the weaker player's EBITDA per ton will move towards the stronger player's EBITDA per ton. The next big deal was there was an engagement between Dalmia Bharat and Binani Cement. Well, that got broken off, and ultimately, Binani Cement has gone to UltraTech Cement. For UltraTech Cement, it was important. They wanted to hold on to their turf. Dalmia was attempting to move into a new geography. Now, the most important part of this deal, and why was Binani Cement so wanted in the industry, because it has limestones of around 380 million tons. The capacity was around 6.25 million tons, which can be scaled up as well. The winner, that's UltraTech Cement, they in fact were very, very happy because they get 10% additional market share in North India. Not just that, the capacity in fact moves up, and they have a scope to increase capacity to around 10 million tons odd. Though for both the parties, that's Dalmia or UltraTech Cement, it would be EPS dilutive for the first couple of years then. So that's what happened in the past year. In terms of profitability for the cement space on the whole, it was down by around 5%. But there's some good news maybe for the second half of the year, because input costs have cooled down. Coal prices have cooled down. You have petcoke prices as well have cooled down. And when we talk about crude oil prices coming down, so that's good news. Input costs comes in lower. Now all eyes are on the cement prices. Can cement prices move up from here? And that's what will help them in terms of an EBITDA expansion in the coming quarter, at least in quarter 4. Those are the graphics up for you. Petcoke, coal, as well as crude prices, and also the axle loading norms that will reduce the freight cost by nearly around 4 to around 5% odd. So the industry is bracing itself for better times, rising demand, improving capacity utilization levels, as well as cost inflation could be coming in lower. So let's see whether or not quarter 4 is a much better time for these cement players.
Thank you, Nigel, for that. Let's move on. Our colleague Parikshit Luthra caught up with the former Prime Minister Manmohan Singh and began by asking about the progress in the GDP growth as compared to the past government, as well as the recent RBI crisis situation. Here's a slice of that conversation.
Well, I'm not an expert in GDP statistics, but I think it's not proper that when releasing the GDP numbers, I think there should be people who have no expertise sitting on the table along with the statistician. So I think that the Deputy Chairman of the Planning Commission was the one who was announcing these new numbers. That reduces the credibility of this exercise.
What about the working of the RBI, sir? You've seen the government so closely, you've seen the financial sector so closely, the crisis within the RBI.
I think one has to respect the autonomy and independence of the Reserve Bank. At the same time, I would say that the relation between the government and the Reserve Bank is like the husband and wife relationship. There will be hiccups, there will be differences of opinion, but ultimately these must be harmonized in a manner that the two great institutions of the government and the Reserve Bank can work in harmony with each other.
Using capital reserves of the RBI to fund a loan waiver, this is being speculated.
Well, I wouldn't like to comment on.
And as we wrap up on Midcap Radar, we leave you with some market opinion from Saurabh Mukherjee, the founder of Marcellus Investment Managers. He says that the market, barring financials, appears to be quite well placed. Thanks for watching. Your Stocks is up next.
I think crude is really the big thing which has swung for India. So whilst the politics has become incrementally trickier in the last couple of months, crude swinging from 85 to 57, this is Brent, I think it really has made life easier. NBFCs and the NBFC finance piece apart, the rest of the economy and the rest of the market's looking up. My reckoning is the combination of a benign macro, which I think we certainly have going at the moment, and a capex recovery on the other side of the election, suggests to me that FY20, there's a decent chance FY20 brings an all-time high. I'm not so sure FY19 will bring the all-time high. And if crude stays where it is, I think the macro will become incrementally more positive as we approach the elections. My reckoning is between September through to Jan, the RBI will pump in around $25–30 billion. That's almost 1% of GDP into the market. But also, we can see alongside that the money market isn't tight, isn't getting any easier. The 10-year, the spread of the NBFC paper against the corresponding duration government bond paper stays very tight, right? So 10-year bond deal is coming up, but the spreads for the NBFCs is staying tight. I think banks are looking like a smart place to be. Banks will not only benefit from the mark-to-market on their government bond portfolios, but there does look like an incipient capex recovery underway in our country. The first early signs that with the capacity utilization rate in our country hitting 75–80%, corporates are thinking about capex. It will probably pick up pace on the other side of the elections, but I think banks are your best play at the moment on an incipient capex recovery.